Have you ever opened your investment app, and suddenly everything is red? Prices falling, headlines warning about panic, experts predicting uncertainty, and immediately, one question appears: should I sell everything? This is the moment when many beginners panic. But here's something surprising: market crashes are not rare events. They are not accidents, and they are not the end of investing. They are actually a normal part of how markets work. In this video, you'll learn what a market crash really is, why it happens, and what smart long-term investors actually do during these moments. Because understanding crashes changes fear into confidence. And once you understand them, you start seeing opportunities where others see danger. Let's start with the most important question. What exactly is a market crash? A market crash is a rapid drop in stock prices across a large portion of the market. Typically, people call it a crash when markets fall around 20% or more from recent highs. That sounds dramatic, and emotionally, it feels dramatic. But a falling market does not mean companies suddenly stop existing. It does not mean the economy disappears overnight. What changes first is not business performance. What changes is investor emotion. In the short term, markets are driven by fear and optimism. When investors feel confident, prices rise. When investors feel uncertain, prices fall. The market is constantly reacting to expectations about the future. And when fear spreads quickly, prices can fall quickly too. This sudden shift in sentiment is what we experience as a crash. Here's an important idea to remember. The stock market is not the economy itself. It is a reflection of how investors feel about the future of the economy. And feelings can change very fast. So why do market crashes actually happen? Do markets just randomly collapse? Not exactly. Most crashes begin with uncertainty. Something changes in the world that makes investors unsure about the future. It could be rising interest rates, a recession fear, global conflict, a financial system problem, or an unexpected global event. The specific cause changes every time, but the reaction is usually the same. Investors begin to worry. When people worry about the future, they try to reduce risk. They sell investments. Selling pushes prices down. Falling prices create scary headlines. Those headlines create more fear. And more fear creates more selling. This becomes a cycle. Fear leads to selling. Selling leads to lower prices. Lower prices create even more fear. This cycle is called market panic. And once it starts, it can move very quickly. Here's something important beginners often misunderstand. Prices fall faster than reality changes. Companies don't suddenly lose all value in a single week. Businesses continue operating. People still work. Products are still sold. But markets move based on expectations, not just current results. When expectations suddenly become negative, prices adjust rapidly. Think about it like this. Imagine a crowd leaving a stadium. If everyone walks calmly, movement is slow and orderly. But if someone shouts danger, people rush toward the exit. The exit didn't change. The crowd's behavior changed. Market crashes work in a similar way. The speed comes from human reaction, not instant economic collapse. And because human emotions repeat throughout history, market crashes repeat too. To really understand market crashes, we need to look at history. Because crashes feel unique when they happen, but they are not new. Markets have gone through major declines many times before. The Great Depression, the 2008 financial crisis, the pandemic crash in 2020. Each time felt different. Each time headlines suggested the future was uncertain. And each time, investors wondered if markets would ever recover. During those moments, fear feels permanent. That's the psychological trap. When prices fall every day, it feels like they will continue falling forever. But history shows something very consistent. Markets eventually recover, and over long periods, they reach new highs. Not because crashes are good, but because economies adapt, businesses innovate, and productivity continues to grow. Think about what markets really represent. They represent thousands of companies solving problems every day. Companies create technology, provide services, build infrastructure, and respond to changing conditions. As long as businesses continue improving and people continue working, economic growth resumes over time. And markets follow that growth. Here's a powerful idea many beginners don't realize. Every past market crash looks obvious in hindsight. But during the crash, uncertainty feels overwhelming. Investors never know exactly when recovery will begin. Recovery usually starts when fear is still high, not when confidence returns. That means many people miss the rebound because they wait until things feel safe again. History doesn't show a straight line upward. It shows progress interrupted by temporary declines. Crashes are part of the journey, not the end of it. During a market crash, most beginners make the same mistake. They sell everything, they panic, and they lock in losses. It feels safe in the moment, but in reality, it is the fastest way to hurt your portfolio. Think about it: if you sell when prices are low, you lock in losses permanently. The market doesn't stop falling just because you sold. And when it eventually recovers, which history shows it will, you may not be invested to benefit from that recovery. This is called selling low and buying high. It is exactly the opposite of what smart investors do. Another common reaction is to freeze. Some people do nothing. They watch their portfolio daily, hoping for a miracle. This constant stress makes decision-making worse. And it often leads to emotional decisions, like selling too early or trying to time the next crash. The real risk during a crash is usually emotional decision-making, not the market itself. Fear can trick you into doing the wrong thing. The market might drop 20%, 30%, or even 50%. But if you stay invested, the long-term trend still favors growth. The key is understanding that crashes are temporary, even when they feel permanent. So, what do smart investors actually do during a market crash? The answer might surprise you. Most of them stay invested. They don't panic, they don't try to time the market, and some even buy more while prices are lower. Why? Because a market crash is essentially a temporary discount on investments. Imagine buying the same companies at 20 to 30% off. Over time, that discount can significantly boost returns. Another habit is consistency. Smart investors continue contributing to their accounts regularly, even during a crash. By doing this, they take advantage of what's called dollar cost averaging, buying more when prices are low and less when prices are high. Over years, this smooths out the effects of short-term market swings. They also focus on long-term goals. Instead of reacting to daily price changes, they think in terms of decades. Retirement, financial freedom, or long-term wealth building cannot be rushed. During crashes, patience becomes your most powerful tool. And finally, smart investors prepare before a crash happens. They invest money they won't need soon. They maintain an emergency fund. They diversify across multiple investments, like ETFs, stocks, and bonds. And they avoid trying to predict when the market will fall or rise. Preparation doesn't stop panic, it prevents it from controlling your decisions. Market crashes feel scary, they create uncertainty, and they make even experienced investors question their choices. But here's the truth: crashes are normal and expected. They are part of the investment journey. The key takeaways for beginners are simple. 1. Don't panic. Selling during a crash locks in losses. 2. Stay invested. Long-term growth is more powerful than short-term fear. 3. Invest consistently. Continue contributing, even during downturns. 4. Be prepared. Keep an emergency fund and only invest money you won't need soon. 5. Think long-term. Focus on your goals, not daily market fluctuations. Remember, every major market crash in history eventually ended, and markets recovered to reach new highs. Fear is temporary, growth is long-term. If you keep this perspective, crashes stop being something to fear. Instead, they become opportunities. Opportunities to buy investments at lower prices, to build wealth patiently, and to practice calm and disciplined investing. Thank you for watching. If you want to learn more about investing in Canada, TFSA strategies, and simple ways to grow your money, check out my next video. Investing is a journey. Crashes are just part of the ride. Stay calm, stay consistent, and let time work in your favor.